Hello and welcome to the Academy of Value Investing. Today we'll discuss a topic discussed in chapter 23, that was shareholders fund. So we realized that a lot of users found it slightly difficult, and therefore I am here to explain it in detail and in a very simple manner. So let's start with what is shareholders fund. So shareholder fund is the axis of assets in comparison to liabilities. So the formula of shareholders funds is total assets minus total liability. What it simply means is that suppose the company wants to shut its business tomorrow. So what will it do? It will sell off all its assets and then pay whatever loans it has, any obligation it has towards anyone. It will pay all of that, and then whatever excess amount is left will be given to the shareholders, will be distributed amongst the shareholders. So it is the amount that the shareholders will get once all the liabilities are paid off, and this is why it is called shareholders fund, because this is the amount that the shareholders will get. So why is this shareholders fund important and how is it formed? Let's discuss it. So shareholders fund is majorly comprised of two aspects. The one is the amount of capital that the company's promoters or founders introduce into the company while incorporating the company. So if I want to start a company and I invest say 1 lakh rupees, that forms part of the shareholders fund. And when I do business, suppose I invested 1 lakh rupees and in 1 year I earned 1 lakh of profit, and that profit I did not distribute it as dividends, I kept it for future growth. So any profit that I retained, that I took to grow the company further, is called retained earnings. So this is the second aspect. Now in the first year there was 1 lakh worth of equity, and after 1 year of operations the company earned 1 lakh of profit that was retained. So now the shareholders fund will be worth 2 lakh rupees, comprising of retained earnings and equity introduced by the promoters. So these are the two heads of shareholders funds. So as company earns profit year after year over a long period of its operation, its shareholders funds balloons subject to the condition that the company is regularly earning profits, whereas any loss in any year will lead to reduction in the shareholders funds because the loss will be taken out from the retained earnings of the company. Now let's discuss how retained earnings are affected. See, when a company earns profit, so whatever net profit you see in any P&L statement, the company has two options. Either it can pay a part of the profits as dividend to the shareholders and distribute it to the shareholders. So since that money is distributed and the company no longer has it, it does not form a part of retained earnings. Only the percentage of profit that the company did not distribute as dividends forms a part of retained earnings. So any company that is very mature and that does not see much capital expenditure in future decides to usually pay a larger amount as dividend, whereas a smaller company or a company that sees that it can grow faster in coming years with more investment chooses to usually keep more of its profits as retained earnings so that it has the capital to invest in future projects. Now this leads to a very tricky situation. We investors, a lot of time depends on a very well-known ratio called return on equity, which we will discuss in the course, to determine which company is good or not. So return on equity basically tells you that on your money, say if you have invested 100 rupees, what is the percentage of return on your money that a company generates. So this is a very important ratio, but this ratio has a very unique relation with shareholders funds and retained earnings. So let's discuss it. Suppose a company has shareholders funds worth 100 rupees and that company earns a profit of 10 rupees in a particular year. So out of that 10 rupees, the company decides to distribute 5 rupees as dividends and 5 rupees as retained earnings. So now the company has shareholders funds worth 105, and on that 105 rupees, the company generated a profit of 10 rupees. Whereas suppose this company, instead of giving 5 rupees as dividend, gave all the 10 rupees of profit as dividend. So now in this case, its retained earnings remained at 100 rupees. So now ROE will tell us that on a capital of 100 rupees, the company generated a profit of 10 rupees. So ROE will be higher in this case because a lot of money was given away in the form of dividends. So usually a company that has a higher dividend payout ratio, a company that pays higher dividend has a higher ROE. but that doesn't mean that that company is necessarily good for you. So often when you are comparing two companies of similar sector, don't just get attracted by higher ROE. Check why the ROE is high. Is it only because one company is paying higher dividend, or is it actually because the company has better business? Boosting ROE by giving higher dividends is in fact at times a negative sign, and that tells you that the company is not sure of its future plan and it has no use of its profit, and therefore it is distributing it to the public. So higher dividend payout is usually a sign of saturation in a company's business. Thereby you should compare ROEs only when the dividend payout ratio is similar. So hopefully this video helped you in clearing your doubts regarding shareholders fund and how it affects the ROE. I'll keep making such videos and you will be getting a lot more video lectures in the upcoming weeks in the Academy of Value Investing. Till then, this is Pranjal Kamra signing off. Bye bye.